Hello and welcome. We've reached the end of the semester. These will be your last lectures. We're going to be talking about cost accounting. And I probably leave cost accounting till the end because it was certainly my least favorite accounting topic when I was in college and grad school. Really didn't like it. Very detail oriented and very, I guess, dry. However, understanding how cost accounting works is key for managers. And I learned that after I left school and started running my own businesses. I ended up using cost accounting a lot, and certainly understanding cost accounting was a key to being able to understand how and why a business works, is profitable or not profitable, and what products work and what products don't work. Really key information in the management of a business. So you don't have to learn cost accounting in the sense that an accountant would have to learn it, but you do have to understand it in some of the key concepts. So we're going to be going over that. This is chapter 8 in your textbook. Um, so first of all, let's talk about some definitions. What is a cost? What's some terminology that we use? Cost is something you sacrifice to get to an objective. So you give something up, a cost, to get to an objective. So the cost of building a specific product is what you had to give up, the resources you had to give up in order to construct the product. You have actual cost, something that's already happened, it's in the past. You have a budgeted cost, the cost that you think something will cost. And most important for cost accounting is a cost object. So a cost object is anything for which determining a cost is useful. So it's not just a product. It's a product, yes, so something you build or sell or whatever it is, the kind of business you're in. It's also potentially any service that you provide. So there's a cost to providing accounting services. There's a cost to providing consulting services or legal services. And that's a cost object if you're trying to figure out what it costs to prepare a financial statement. If you're an accountant, you can figure that out. That's a cost object. And finally, it may not be something that you sell at all. It just may be something that you have to do. What's the cost of customer service? What's the cost of running the warehouse? What's the cost of shipping a box? It's not just the shipping fee, it's the packing and the cost of the cardboard and the tape and you name it, all the indirect costs of maintaining the warehouse and heating the warehouse and so forth. All of those are part of the cost of shipping a box. And how you track those costs and how you determine what those costs are is key. So let's look at a few object examples from a BMW plant, the one in, I think it's in South Carolina, where they build a lot of their SUVs for the world market, not just for the US. So the product that we're talking about here is the BMW X5. The service cost object is the dealer hotline. So we're maintaining a dealer hotline to support our dealers. What does it cost? Per dealer, per call, per car sold, per whatever. What's the cost of that hotline? We might look at a cost of a project. So an R&D project to enhance the DVD system. Possibility that we might want to know what that cost of that particular project is, and we might be doing lots of R&D projects at the same time. So how do we allocate the overhead of the R&D department to this particular project? And then we might want to look at the activity of setting up production machines. So when we switch from a version A to a version B BMW X5, which has, one of them has CarX and one of them doesn't, what does it cost to change the production process to add or not add that particular accessory to the car? So setting up production machines for changes in production is really what we're talking about here. So we might be looking at activity. Some more terminology. When we run a cost system, we have to accumulate costs. So we collect data in some organized manner so that we can analyze it. So that's called cost accumulation. And then on cost assignment, we have to know where to assign these costs. And some costs that are accumulated can be directly assigned to a specific cost object. Those are called direct costs. And then some costs can't be assigned. And how we decide this, so direct costs are costs that can be conveniently and economically traced to a cost object. Almost any cost could potentially be traced to a cost object, but the cost of doing so from a convenience or cost benefit basis may be too large. So we need to understand how we're going to track a cost to a cost object. If we can do it conveniently and economically, then we will consider those to be direct costs. Costs that can't be conveniently or economically tracked or traced to a cost object are indirect costs. And indirect costs we allocate using some kind of a formula. So indirect costs, we'll talk about direct costs. Very important to understand the difference between these two, because if you get your allocation of indirect costs wrong, you can end up with some very bad data that may cause you to make very bad decisions. So indirect costs exist everywhere. You have to always figure out what they are, but then the allocation process of those indirect costs is really important. So for instance, I'll just give you an example. You guys are all taking online courses aiming towards a graduate degree. Maine Maritime Academy has a lot of indirect costs. The maintenance of buildings, the maintenance of the infrastructure, the maintenance of the lawns and gardens and trees, maintaining the waterfront, maintaining the ships and boats at the waterfront. All of those things are indirect costs. We can't trace them directly to any particular course or any particular income stream. So should they be allocated to the online program? We have to have them. They are an indirect cost to all programs. Should those indirect costs be allocated to the online program? Now, other indirect costs that the school has include IT and finance. Once again, these are indirect. We can't directly trace them to a particular cost object like the cost of this course, but should those be allocated to the online program? And how should they be allocated? Those are the kinds of things you deal with indirect costs. How do you do that? How do you allocate those costs? They're costs, they're real, they have to be paid. The school is not going to exist without those costs, but they're not easily or conveniently or economically traced or tracked to the online program. So how you allocate those costs is important. Because if we allocated all those costs to the online program, maybe we'd have to double the tuition. That might not be something that you'd like to see. So difficult stuff, hard stuff to figure out in many cases. We're going to look at some easier things here. So BMW has to assign cost to a cost object. Direct costs, steel and tires in a BMW X5, we can figure out exactly how much steel and exactly how many tires, sounds like 4 or maybe 5 if there's a spare, go into each and every BMW X5. So we can trace those directly to the cost object. And we can know exactly what they cost. We know what those tires cost. They go into the BMW X5. They get shipped with the BMW X5. It's a cost object. Indirect costs are harder. We lease our plant where we make the X5, but we also make a bunch of other kinds of cars there. We don't just make X5s. How do we allocate the lease cost of the plant to the BMW X5? Well, there's lots of ways you can allocate. You can allocate based on the amount of space the X5 uses relative to the other cars that get produced. We could allocate it based on the revenue that the X5 produces relative to the revenue produced by the other cars. Are those fair allocations? I don't know. I'm not familiar with the process, but that's how we take indirect costs and allocate them. And it's obviously very important, just like my example from Maine Maritime. How do we allocate them may decide whether we do a program or don't do a program. Is the online program generating revenue, positive revenue, or not? Depends on how you allocate the indirect cost. You can make it look like it's very profitable, or you can make it look like it's not profitable. That's not really important, perhaps, but it is, because we have to decide whether we should be doing online education or not. And what it means to do online education, is it positive for the school or not? Difficult questions, difficult problems. That's what cost accounting does. So some examples of direct costs: parts and assembly line wages. So direct labor and direct material is what another way of calling these things, are generally direct costs. So material and labor that goes directly into a particular product. Easy to figure out. My salary for this course is directly traceable to this course's revenue, or to your costs, if you will. So that's easy to trace. You can't have the course without the professor, so the professor's costs are easy to trace. Not so easy to trace the indirect costs, like in the examples here: electricity, rent, property taxes, and let's say IT services. Those are indirect. And in the case of this course, how do we trace IT services indirect costs? How do we allocate those costs to this online course relative to all the other courses that are taught at MMA? As far as how we decide whether to do direct or indirect cost classification, materiality is a big thing. If it's not a significant number, we're not going to worry about it. We're not going to try to track something that's small. So at BMW, they probably use grease guns on all of their cars. Is it material to track the cost of the grease that's going into a X5 relative to some of the other cars that they're building in that plant? Or is it such a small number that it's not worth tracing the grease that goes into each car? Depends. If it's too small a number, it's not worth gathering the information and tracking the information. So we may, if it's immaterial, if it's too small, we may ignore that. So in terms of education, the cost of chalk, erasers, and whiteboard markers may be immaterial, may not be worth tracking those costs to the specific courses that they're used in. So whenever we're gathering information using IT systems or other methods, we always have to look at a cost-benefit analysis. Is it worth gathering the information based on the materiality of the costs? Now, the perhaps more important thing, we've talked about direct and indirect costs, but we also have variable and fixed costs. And this is really, really important to understanding how costs work. So variable costs change based on volume, activity or volume. Fixed costs stay the same even as volumes or activities change. in both cases, variable and fixed costs, we always talk about the relevant range of these costs. So the range that they are fixed or variable. Really important, because as you jump beyond a relevant range, your fixed costs can change and your variable costs can change. So if you think about the BMW example, if they're suddenly building so many cars that they need to add another plant or another production line, then their fixed costs are going to change quite dramatically as they add a second plant. Other things that we talk about in cost accounting, we talk about cost drivers. And a cost driver is anything that changes costs over a given span of time. So whatever it is that we're doing that changes costs is a cost driver. Relevant range I just talked about. We can jump beyond that. I've already addressed that with the last slide. So it's important to understand that variable costs, which change in proportion with output, in terms of a per unit cost, are unchanged in relation to output. So the per unit cost, the cost is variable, the per unit cost stays the same. So if the cost of making X5s includes tires, every X5 has 5 tires, the cost per unit for tires is the same. Every X5 has the same cost. The total dollars every time we produce another unit go up by the cost of 5 tires, but the cost per unit stays the same. Fixed costs work exactly the opposite. They don't change relative to output, but they go down the more output we have. So they change in the opposite direction of output. So if we have a fixed cost, let's say the plant cost for X5s, and we produce 1 X5, all of that cost becomes the cost of that 1 X5. When we produce 2, the cost per unit drops in half. So the fixed cost, the plant cost, is the same whether we reduce 1 unit, 2 units, or 20,000 units. It changes inversely with output. So that's a little bit of a mind twister, but important. We can look at a chart here. This shows you your graph. Variable cost of steering wheels at $60 per unit for the BMW X5. As we produce units, there's a straight line, ascending straight line of costs. The supervision cost for the assembly line, $2 million, doesn't matter whether we produce 0 units or 60,000 units, stays the same. So it's a flat line. So fixed costs and variable costs, really important to understand the difference between those two. Be very careful, and this is a mistake that managers make all the time. They say, oh, the unit cost of that blah, blah, blah is X. Well, it's generally not X. It's X at a certain level of output. It's X plus or minus depending on how the output. If output falls, usually the unit cost will rise, and if output rises, the unit cost will fall. So be very careful when you talk about cost as a unit cost, or because it's not a fixed number. As long as there's fixed costs involved, the more or less you produce, you're going to change your cost per unit. So very important to understand that. Sometimes unit costs are also called average costs. So we've talked about this, costs can be direct or indirect, and they can be variable or fixed. So you can have direct variable costs, you can have direct fixed costs, you can have indirect variable costs and indirect fixed costs. So all of those things mean and act differently. It's important to understand them. So let's think about this. Variable costs for the X5, tires used in the assembly of the automobile. We've talked about those are direct and they're variable. Direct fixed costs would be the salary of the supervisor on the X5 assembly line. So we have a supervisor who has to be there, whether we're assembling 10 cars a day or 50 cars a day, the supervisor still has to be there. So he's a fixed cost, he or she is a fixed cost, but it is also a direct cost. You go over to the other column, the indirect costs. The power costs at the plant, where we produce lots of different kinds of cars, is variable. It goes up and down depending on how many products we're assembling. But it's not directly just to the X5, because we produce lots of cars at this plant, lots of different kinds of cars. So it's an indirect cost, not directly traceable, but it is variable. And then the lease costs at the plant, the cost of leasing the plant, are also indirect, but they're fixed. So two different kinds of things, fixed and variable, two different kinds of things, direct and indirect. And then you have different kinds of firms. You have manufacturing firms who purchase materials and convert them. And then you have retailers and wholesalers who buy finished products and sell them without changing them. So they're buying and reselling. And then you have service sector companies that sell services or intangible products, accounting services, consulting services, legal services, that sorts of things. Education, another service sector company. So manufacturing is a little bit more difficult, because manufacturing creates assets before it creates costs. So when we manufacture something, it becomes inventory. And it's inventory until such time as we sell it. So we don't have costs when we manufacture BMW X5s. We're actually capitalizing these things or recording them as assets until we sell them, and that's when they become a cost. So they're inventoriable, and these things become inventory. Materials, labor, and indirect manufacturing costs become inventory before they become costs. So those are all inventoriable. And then we also have period costs, where we don't inventory them, we expense them. And we're going to talk about those in a second. So these costs, the ones that become costs, show up in cost of goods sold, and that has to do with the flow of costs through a production system. And we talked about this earlier, much earlier, when we talked about inventories and financial accounting. So here's a graph, and I skipped over those other slides. You can certainly read them at your leisure. But this is really the process, or the flow chart that happens. We have for manufacturing, we have a direct material cost, and we have direct labor costs. And we also have indirect manufacturing costs. And those all become part of our inventory. They become part of work in process inventory. And then work in process inventory, when it's finished, becomes finished goods inventory. So here we're all still on the balance sheet. And we stay on the balance sheet with any ending inventory, so goods that we haven't sold. So everything happens here on the balance sheet side. But the finished goods inventory that are sold become cost of goods sold. So some of the finished goods inventory is sold. Some of the finished goods inventory ends up as inventory, not sold. So now we have sales minus cost of goods sold is gross profit or gross margin. Then we have the other operating expenses, which are period expenses. Research and development, design, marketing, distribution, and customer service. These are all related operating expenses, but are not inventoriable. So they're just period expenses. So when we do R&D under accounting rules, R&D gets expensed. Design gets expensed, marketing gets expensed, distribution gets expensed, and customer service gets expensed. So all of those things get expensed each period as we spend the money. They don't end up as part of inventory. So remember that, because this is very important. Obviously, these things aren't expenses until such time as we sell the goods. So figuring out costs has a lot to do with lots of different things, and we may use different cost methods for different decision making. So if I'm deciding how to price my product, or I'm deciding what kind of a product mix I want, I might use one kind of a cost. If I'm figuring out costs because I'm contracting with the government, I may have a cost plus contract. Therefore, my costs might be very different. I might be looking at a different kind of a cost than I would in making my pricing and product mix decisions. And then finally, GAAP has certain rules for preparing financial statements, and I might be looking at, once again, a different set of costs. So obviously, for GAAP, I'm looking at the physical cost. If we go back here, I'm looking at the direct material and direct labor. Those are my costs. But if I'm trying to figure out pricing, I need to include all this stuff because I can't sell product unless I've done this stuff too. So here I've got costs that aren't in the inventory, but are part of my pricing and product mix decisions. So here's a chart. You go from R&D, design, production, marketing costs, distribution costs, and customer service costs. Here's all the costs necessary to deliver my product to my customer. And if you look down here, I need to look at all those costs when I'm figuring out pricing and product mix decisions. When I'm looking at just GAAP, all I'm looking at is production costs. I don't include design, R&D, marketing. My cost of my product and inventory is right here. It's just the production costs. And then when I'm looking at my government reimbursement, I probably include some or all of my R&D, all of my design, and my production, but I don't include any of these things out here because the government doesn't want to pay for marketing and distribution. They only want to pay for design and production. So, and maybe R&D, depending on the contract. So different kinds of costs for different kinds of management decision making. So cost accounting and cost management, we have to calculate or accumulate the costs of products, services, and objects. We need that information to plan, control, and evaluate performance. And it's a decision-making tool. If you don't have good cost information, you make bad decisions. If you are looking at something and thinking it costs more than it actually costs to produce and deliver, then you may decide to set the price too high, or you may decide it's not worth making. And if you think that something is costs less than it actually costs, you may sell it at too low a price, or you may sell it at a loss without realizing it. Now remember, you're talking about companies with, or organizations with lots of products. It's hard to split them out, but you have to make these decisions constantly. Should we drop this product or not? Should we add a division or not? Should we go into this other market or not? Those are all cost decisions, and you need to have good cost information. As I said at the beginning of the lecture, none of you are cost accountants, but you have to understand the complexity of cost accounting. And at some point in your careers, you'll probably have to argue with the cost accountants because they, at least you think, they are misallocating costs to your specific area, whatever specific area you may be involved in. And you have to make strong and cogent arguments that they're, say, taking indirect costs and charging them to your division when they shouldn't be. And those are hard arguments to make, but almost every manager ends up having to make those arguments at some point. Okay, that wraps up this lecture. Thank you, and we'll continue later.